Are you ready for some money magic? We are at Smart Money. Hi, I'm Julia Anderson here at Smart Money. My co-host Pat Boyle and I are going to be talking to a special guest today, Lawrence Kotlikoff, professor of economics at Boston University, advisor to many government agencies and national boards, author of 19 books. Is that right, Larry? And hundreds of professional articles. Yeah.
20.
The Economist.
20.
Here's the big deal. The Economist magazine named him among the world's 25 most influential economists. And that's something, because there's a lot of economists in the world. So I want to get to a lot of things in his new book, Money Magic. Before I do, let me just say that more than anything, Larry is an expert on personal finance and retirement planning and managing your nest egg in retirement. And the last time we spoke, something like 10 years ago, he was just starting a software project so that you could take this software and figure out your own retirement plan. And he's still at it. He calls it the behind the scenes star of Money Magic. It's something called Maxify Planner. And the book is called Money Magic, An Economist's Secrets to More Money, Less Risk, and Better Life. So to kick it off, we've got Pat Boyle here to ask you the first question.
Great.
Yeah, Larry, I was wondering, most Americans who make financial decisions really have no clear idea how it's going to impact them in the long run, or even understand the dangers those decisions might pose. So tell us, what can people do to rescue their retirements in their 50s and early 60s?
Well, the first thing they can do is not retire. Retirement is the decision to take the longest vacation you ever have taken. And you could end up retired longer than you actually worked. So retirement is a really risky decision. So I would urge people to really wait, make sure they're saving enough, do some simple calculations. The book lays out just with simple arithmetic how much you can figure out that you need to save, and make sure you're saving enough for your possibly living to 100, to your maximum age of life. Don't count on dying on time at your life expectancy, because none of us really dies on our life at the right time when the statisticians say we will. We have to worry about the downside. The catastrophic risk here is not dying, it's living, because we'll run out of money. And then there's, properly dealing with Social Security, not taking it too early, because there's an enormous payoff to being patient with respect to your retirement benefit. You can get a 76% higher number if you wait till 70, adjusted for inflation, than if you take your benefit at 62. So there's lots about Social Security. There's lots about how to deal with your retirement accounts, when to start withdrawing, to lower your taxes, Roth conversions, these kinds of issues. And then don't overspend on housing, downsize when the kids leave. There's plenty of ways to go from house poor to house rich.
Your book covers a ton of topics, and in it you've got something you call financial shockers. And my personal favorite financial shocker was, what's the best advice for a young single person? And your best advice is shack up with your mom, because that means you're not going to be paying any rent, and a few other money saving ideas. So why don't you share a couple more financial shockers with us, Larry?
Well, I'll just share them, but I'm not going to have time to explain them. But the rich should invest in bonds and not in stocks. They should invest in safer things. The poor should invest in riskier things. As you get older, you should be putting more of your financial assets into stock as you're in retirement. Those are two completely crazy, off the board, off the wall propositions, but they're completely grounded in the economics of finance. They're completely sensible when you understand them. The idea that stocks are safe in the long run, which Wall Street is peddling that idea to get people to invest more and more in stocks, not true. They're a random walk, and they're extremely dangerous. Time the market. That's an idea that people think is crazy. You should not time the market, but indeed you should time the market when things get riskier, as they are now with this new variant of COVID. We should time the market. We should be moving out of stocks and other risky securities because there's more risk. And when there's more risk, we want to take more precaution. So those are just examples just on the investment side, but there's so many examples, like marry for money is, who would tell people to marry for money these days? I would, and I do in the book. Divorcing in a way that doesn't lead to divorce like an economist would do it. I talk about that. So there's just a range of, think about choosing a career that other people hate and you love, like being a mortician. How many people love being a mortician? Not too many, right? But if you can take that because you like quiet clients, then you're going to make a bundle compared to what you'd otherwise do.
Well, Larry, I'm going to argue with you a little bit on one of your financial shockers, and that is time the market, because I think it's easy to get out when things are scary, but it's very hard for your average investor to figure out when to get back in. And in fact, my blog says just hold tight and the markets will come back. And by the way, you're going to buy stocks at a cheaper price on a bunch of stuff. So anyway, we'll leave that one for a later conversation. I'm wondering, in your book also, you have some success stories with real people involved. Would you mind sharing one of those with us?
Well, I was writing a syndicated column for a while in personal finance, and my editor, out of the blue, decided to retire, and he was like 65, and he said he was going to take a Social Security right at 65 and wait till 70 to take his retirement account money. And I said, well, let me run you through our software. I think that's the wrong thing to do. And indeed, it is. I made him about $100,000 relative to what he had in mind doing, because he was assuming that the stock market was a sure thing. And the stock market has been yielding about a 6.5% real return over time. That's fantastically high compared to investing in a safe asset like inflation index bonds. But the thing is, the stock market's very volatile. In a given year, it moves like 20% up or down. So, and we've seen it crash in 2000. It dropped in half. It dropped in the Great Recession in half, or more than half. It dropped 86% in the Great Depression. It's very risky. So when you risk adjust it, the return on stocks is much lower than the return on Social Security, on being patient with Social Security. So when I explained this to him and got him to understand that you can't count on stocks paying off because there's risk, you have to adjust for it. You have to look at how the market is pricing the risk. When you do that, it turns out on an apples to apples basis or risk adjusted basis, it was much, much smarter to take the retirement account money first and be patient with Social Security. Because again, you get a 76% higher number at 70 than at 62. And of course he was 65, so it was still a much higher number than taking it at 65.
Speaking of numbers, I think 2/3 of people retire like in their late 50s or early 60s. You're an advocate of retiring later, correct?
Yeah, if obviously some people, because of physical reasons, cannot do that, cannot wait. But there are different kinds of jobs you can go into. I really think people need to understand that there can be medical advancements that keep us alive for much longer than we would expect. And that we might, a lot of people are living into their 90s. If you're a couple, the probability that you or your spouse will make it to 90 or beyond is pretty high. So you have to look at the catastrophic case of living to your maximum age of life. Just like when we think about homeowners insurance, the catastrophic case is the house burns down. So we insure ourselves by getting full coverage. Here, full coverage is we got to deal with the possibility that we make it to our maximum age of life, and that's 100 probably for most people, and that's the planning horizon. So, that you have to start with that aspect that you can't play averages.
Pat, I know you have a follow-up question on Social Security, so why don't you follow up with that?
Well, yeah, you were saying it's better to tap your tax-deferred savings before you dip into your Social Security. I want to hear, because you also say in your book, and this caught my attention, you should pay off your mortgage with your IRA and get it out of the way. Tell me your thinking about that.
Okay, so just on the Social Security, it's not the case for everybody. You know, everybody's a little different. And so I would say for about 85% of households, they should be waiting till 60 to take, or households should be waiting till 70 to take Social Security. And probably about 6% are doing that, no more than 6%. So we've got an enormous mistake going on with respect to taking Social Security. And there's another 12 benefits to Social Security. So there's a lot more to talk about with respect to that. But in terms of paying off your mortgage, suppose you had a 3.5% mortgage today, and you can earn 2% on long-term treasuries. Well, there's a 1.5% differential there. So if you took suppose you had your IRA invested in long-term treasuries earning 2%, and you took the money out and you pay taxes. Well, you have to pay taxes on the money eventually. So maybe you're temporarily in a low tax bracket. Maybe you've just retired, for example, or you've been furloughed. So you take out the money, you pay the taxes, you pay off your mortgage. Now you're making a 1.5% differential. That's a completely safe arbitrage. Now some people might say, well, you should leave it in the market because the person should take the money out of long-term treasuries and invest them in stocks. Well, stocks are highly risky. Once you risk adjust, the nominal return on stocks, risk adjusted, is the return on treasuries. Because of the margin, people are investing in both. So that's the relative, risk adjustment right there. It's determined by the market. So we can't count on our house not burning down. We can't count on dying on time. We can't count on the stock market. We have to do an apples-to-apples comparison in these kinds of cases, financial decisions. And so another way to think about this, Pat, is that if I leave my mortgage out there and I have my IRA invested in stock, what I've been effectively done is borrow to invest in the stock market. Suppose, Pat, that I do what I'm saying, which is pay off my mortgage. I take out the money from the IRA, pay off the mortgage. Now I've got no mortgage. I've got much less money in the. Would I then turn around and go borrow money to put in the stock market? Would I undo what I just did? I don't think most Americans would borrow to put money in the stock market. And that's what they're doing if they don't pay off their mortgage. They're borrowing to put money in the stock market.
Okay.
It's hard to get my head around some of this. So we're going to another of my favorite topics, divorce. So what's your best advice for a divorcing couple? And divorce does happen. We know that something like 30 to 50% of marriages end in divorce, and it's a really big deal, especially for women. So what's your advice?
Well, 4,000 people are getting divorced a day. I think 11,000 are retiring a day. So it's a huge problem issue. And a lot of these divorces are leading to divorce war, where the couples are fighting with lawyers, very expensive, and the kids get damaged in the process. It's just terrible. So what I'm saying is, look, what you need to do is figure out before you do any discussions about anything, figure out what relative living standards the two of you think are fair. So maybe the wife has got a really intense job and is going to work till 65, and the husband has an easy job and he wants to retire at 55, and maybe they're both 50. So, these are the resources they have are different. The labor income in the future and their Social Security benefits are different. So, all this stuff set aside, given how long they've lived together and given all the other factors, do they want to have an equal living standard going forward? Do they think that's a fair solution? Do they think that the wife should get a somewhat higher living standard because she's going to be working more intensively, as long as she continues to work in the market? So you figure out the relative living standard that you think is applicable, and then go to the data, then go to the numbers of your household and figure out what allocation of resources they go from the let's say from the husband to the wife or the wife to the husband in terms of alimony or division of assets will produce that living standard ratio that they think is fair. Suppose they've been married for 30 years. They don't hate each other. They think they both should have the same living standard going forward. Well, it's an easy calculation. Suppose they think it should be maybe for some reason or other, the husband should get to spend an extra 20% compared to the wife. Figure out that ratio and then make the calculation and then go get a lawyer to write it up and be done with it. Don't have a war over it because, in the end, we're going to end up with that kind of a solution anyway. You discuss kind of the fundamental, which is the relative living standard that you're going to try and end up with.
I like that idea.
Okay.
I want to ask you, your book, which again is Money Magic, you say that we should invest like an economist. What does that look like?
Well, one way to invest safely, and I think this holds for the middle class and upper income people, really for anybody, is to look at what happens to your living standard, what kind of living standard risk are you incurring? Because through time you're investing maybe in a risky way, and you might be spending aggressively. So what kind of trajectory of your living standard might you end up with? Because there's going to be good and bad trajectories. So thinking through these trajectories is something I talk about in Money Magic, but I also talk about a way in which people can invest such that they don't have any downside living standard risk. And it's really simple. You think about, you figure out how much money you have in the stock market, how much you're going to add to the stock market, and then you assume that all that money is lost, 100%. The rest of your assets you invest perfectly safely in inflation index bonds, which are treasury bonds adjusted for inflation. And then you form a living standard floor based on those safe investments. So you figure out a plan to spend such that you'll always be able to have the same living standard through time. And I show in the book how to do this just with simple arithmetic. And then you also decide at some point to start withdrawing from the stock market if there's still money there, and when you're going to stop withdrawing. And when you take the money out, that's when you can increase your living standard floor. So you have this living standard floor. I hope that everybody can see me. It's a floor to your living standard, but then at some point it's going to ratchet up. There's different trajectories by degrees to which it's going to ratchet up depending on how the market does, but your living standard will never drop. So this is a very simple trick for flooring your living standard and just having upside risk. And I think for the middle class, this is exactly what they want to do. They want to have their living standards secured, but they still want to have some money in the market. So it's a combination of spending not out of the stock market money until it's been made safe. It's just like when I go to the casino in Vegas, I leave my wallet in the hotel room. I take a couple $100. I go to the slot machines. I don't spend any extra money until I leave the casino. If I've lost the $200, well, my living standard's been secured because the wallet is back in the room. I haven't used my credit cards to buy chips. So this is like casino investing. And that's how I got the idea. So that's really, I think, what we need to think about, securing our living standard and just having upside risk.
I like the casino mentality. I think that's a great idea. Leave the wallet in the room. And so we're running a little short on time. And so our last question here, or almost the last question, is could you please name your 4 favorite money magic tips?
Well,
quickly.
Okay, quickly. Yeah. Okay. So be patient with Social Security, know all the benefits. Don't retire if you can help it, or retire much later than you were thinking, and calculate how to smooth your living standard. Therefore, how much you need to save in order to keep your living standard secure if you live to your maximum age of life. And
Quick,
finally,
hey,
one more. Wait, one more.
the last one is invest for the upside and engage in upside investing.
Got it. Now, where can viewers find out more about your book, Money Magic, and your columns?
Well, they can pre-order it right now from Amazon or their local. I prefer the local bookstore, to tell you the truth, but they can get a hold of it, and it's going to be published on January 4th. And then Kotlikoff.net is my website. I publish, post all my articles and columns there. And there's also our software is Maxify.com, Maxify.com. But most people, I don't think, want to use software necessarily. I think this is why I wrote the book, because I wanted to take what I learned from the software and put it into the book and help people that way, who are not do-it-yourselfers. But the software is really simple to use and a lot of fun. So do one thing, either buy the software, buy the book, buy both. Yeah.
Something you say in your book at the beginning, I think, is that Americans are lousy savers. And so the trick is for all of us to get people to actually be thinking about retirement, not just crossing their fingers and hoping it all works out. And so we just really want to thank you for spending time with us on Smart Money. We've been speaking with Lawrence Kotlikoff, financial columnist, economist, and author of many books, including his latest, Money Magic, and Economist's Secrets to More Money, Less Risk, and a Better Life. And it's on sale on Amazon starting January 4th, but you can pre-order it. And Larry, thank you so much again for being with us on Smart Money.
It's my great pleasure. Thank you so much.
For more information, go to my website at 60andsingle.com.